Hey guys, what's going on? It's your big dreamer and doer, G Dinero, coming to you today with another Financial Freedom Friday. This time I'm going to answer the question, can strategy or MicroStrategy be your own personal money printer? But first, remember, none of this is tax, legal, financial, investment advice. It's your buddy G Dinero helping you increase your financial literacy to help put you and your family on that path to financial freedom. So let's dig in. So the inspiration from this actually came from Adam Livingston. He goes by Adam Liv or something like that on X, on Twitter. He came on the scene hard over the last 6 months or so. Also over on YouTube. He's got a YouTube channel. Kind of quirky, but fun to follow. And the crazy thing was I had this planned out, and then he put out a post about it on X about a week ago. And I'm like, okay, I gotta make a video about this thing so people kind of understand how strategy can be your own personal money printer. So, Adam, thanks, buddy. I appreciate the kick in the rear end to get this video done. And what do I mean by make MicroStrategy your money printer? Well, normally, you'd have to shell out somewhere between $30,000 to $40,000 for 100 shares of MicroStrategy. But what if you don't have that kind of money? What could you do instead of that? Well, step one, you could buy a Leaps, right? That's a long call. And what could you do? You could do the poor man's covered call. So instead of buying the stock, which is going to cost you around $33,000 right now with MicroStrategy at $330 a share. When I made these slides, it might be at $335 when you watch this. Heck, it might already be at $500. You might be watching this a month from now, right? But you could, instead of buying those shares and shelling out $33,000, you could buy a Leaps or a long call that is deep in the money that expires out over a year, right? So for example, you could buy the December 2027 MicroStrategy 250 call, and that would cost you $160.35 a share or $16,035. It has a delta value of 80.4. So for reference, 100 shares equals a 100 delta. So theoretically, this option is going to act like, based on price movements, 80 shares of stock. So you're spending less than half of what you would for 100 shares, and you're getting the price action of 80 shares, and you now have something that you can sell covered calls against. That's the poor man's covered call. So step one is you buy that Leaps. You buy again, in this case, hypothetically, I'm not giving financial advice. Remember, I already said that, but this is a strategy. You could buy a deep in the money call option like a December 2027 250 call on MicroStrategy and then sell an out of the money covered call against your Leaps, right? So for instance, you could sell the October 17th, 2025 MicroStrategy 410 call that has 43 days until expiration. The premium or cost of that is $6.30. So you're collecting $630. So you can think of it as you're renting out your Leaps or your synthetic shares to somebody else, right? So you buy the call, you buy the long call, you sell a short out of the money call expiring within the next 4 to 6 weeks against it. So here's the math, or maths, depending on where you're from. So the net debit to start was, remember, $160.35. That's what the Leaps cost you, minus $6.30. That's what the short call gave you, you collected, equals $154.05 a share, or $15,405. So this would cost you $15,405 to get started. Your break even is the 250 long call plus the $154.05 that this thing costs you to get into, $404.05. A little bit high, right? But remember, this thing, the long call doesn't expire until December 2027. You have a lot of time on this thing. So if MicroStrategy is greater than 410 at expiration, and assuming you did nothing, you would keep the $630. That's a 3.9% return in 43 days. If you were able to do this over and over and over again, you're making a 33% APR, right? sorry, that's if MicroStrategy is less than 410. If MicroStrategy is less than 410 at expiration, you keep the $630. It's a 3.9% return and a 33% APR if you did that 8 more times over the course of the year, right? Now, what if MicroStrategy is over 410 at expiration and you do nothing? You'd walk away with $16,630. Where do I get that from? Well, again, if it goes to 410, that's 410 minus what's your strike price on your long call, 250, for a difference of $16,000. What did you get for the short call up front? $630. What would you get for the long call if it got called away from you at 410? $16,000. So you still walk away with a $600 profit. You can't lose either way, right? Can't lose either way in the short run. But what if you go to step 3? Step 3 is the roll. What if MicroStrategy just rips straight up to 410 prior to the expiration, right? Before October 17th, 2025. Well, you can roll that short call out another month and up another, let's say, $10 to $20 on the strike price. So how does that work? You buy to close the existing short call, covered call. You sell to open a new short call, covered call, about an extra 30 days out, and at a $10 to $20 higher strike price. You may only collect an additional $5 to $10 a share, or $500 to $1,000, but you still collect an additional $500 to $1,000. By the way, don't make the mistake of rolling the call up too high. We're not in this thing to like hang on to the long call option indefinitely. We're into this thing to generate perpetual income, to have that money printer like JP does over at the Fed, to have that money printer printing cash for us every single month to the tune of $500 to $1,000 or more. Could be more, right? I sandbagged the heck out of this, I feel like. But you don't want to roll it up too high. Remember, we're in this thing to make money, not spend money. What if MicroStrategy stays flat to expiration? Meaning you sold this thing and MicroStrategy just stays here in this 330, 340, 350 range. Just roll the short call out. Don't roll it up. There's no reason to buy yourself more room when it's still all the way down here at 330, 340, 350. You don't need to roll that 410 up any higher. Just roll it out. So for example, you'd buy to close the existing short call. You'd sell to open a new short call about 30 days out at the same strike price and likely collect an additional $5 to $10 a share or $500 to $1,000. Those are estimates. It's going to vary wildly along the way, right? But this is just to give you a good hypothetical example. It could be $2 to $3 a share. It might be 15 or 20 if the implied volatility has expanded, right? Also on step 3, also on the roll. First one was if MicroStrategy ripped straight to 410 prior to expiration. Second one was it just stays flat, so it's staying around that 330, 340, 350 range when you put the trade on in the first place. What if MicroStrategy tanks? Well, you can roll the short call out and down. For example, you can buy to close the existing call and sell to open a new call about 30 days out and minus $10 or $20, let's say, on the strike price. I did say only $10 here for a reason in a second. But what would you do then? You would collect an additional $5 to $7.50 a share or $500 to $750. Why is it less? It's less because MicroStrategy is going down in price. The options market then for short calls is going to go down. The implied volatility is going to contract. So the options market the premiums will be less juicy. That's why we always say, wait for spikes to sell covered calls. But in this example, we're just talking about rolling something on a monthly basis. It's a poor man's covered call to generate income. So in this particular case, you decide to go ahead and do it. Why do you only roll it down 10? Well, you don't want to roll it down too much or else you compress the spread between the long and the short option. What do I mean by that? Well, if you have a leap at 250, and let's say MicroStrategy pulled back to 300. So instead of selling the 410 call against it again, you turn around and roll that down to 350. Now the spread between the two options is 250 on the long call, 350 on the short call. It's a $100 spread. If your long call got called away from you, guess what? You're only going to get $10,000 for that long call. Who cares how much extrinsic value it has left on it? If it gets called away from you, you get the spread, basically. So if you sold a short call at 350, bought a long call at 250, the difference between the two is $100. The most you're going to make if you let it get called away is $10,000 plus whatever you got for rolling it, $500 to $750, right? But you paid over $15,000 for this sucker. You don't want to let it go for any less than that, right? So make sure you keep that spread. In this particular example, the spread would be 250 to 400. It's a $150 spread. If you got called out, you'd get $15,000 back, and you would still come out either at break even or slightly ahead. Okay? Here's the comparison. If you had to go out and buy 100 shares at $330 a share, it would cost you $33,000. Instead, you could buy 2 of the leaps that I mentioned before, the December 17, 2027, 250 strike price MicroStrategies, and they cost you about $16,035 a piece at the time I made this, times 2 equals $32,070. So you'd actually have about $1,000 left over. If you were to earn $5 per short call sold and you did it every 5 to 6 weeks, I think you could do it more frequently, every 30 days, right? Every 4 weeks. I also think you could collect more than $5. I sandbagged the living snot out of this. That'd be $5 times 9 rolls over the course of a year. That's $4,500 in a year. So you could do that about 9 times over the course of the year and collect $4,500. But if you have 2 leaps, that's $4,500 times 2, or $9,000 generated in a year. $9,000 over the $32,000 that you have invested is a 28% APR or cash yield. That's just the yield. That doesn't include the capital appreciation of the underlying. What if MicroStrategy along the way goes to 500 and you've been rolling this call from 410 to 420 to 430 to 450 to 470 to 480 to 480 to 490 and finally 500? How much is the call option itself worth? Well, at 500 minus 250 is 250. It's $25,000 that the leap itself is worth for you then. Not to mention the fact that you've been yielding cash off of it all along because you've been renting it out to somebody else instead of just buy, hold, and pray like everybody does, right? Buy, hold, pray. Why not make some money? Why not trade? You got to ask yourself, are you an investor or are you a trader? If you're a trader, you're going to want to do something with those leaps. That's the third leg of the stool that James from Invest Answers is always talking about. If you're an investor, not a trader, just buy it, hold it, and see what happens by expiration, right? And if it goes down in value along the way or goes up in value along the way, whatever, you could sell it, you could close it out, do whatever you want to do with it. This gives you something to do along the way where you can generate a yield. By the way, if you got $10 for every short call, you double that. That's like a 56% APR. It also means you'd make about 18 grand over the course of the year on these things, right? So, and again, that's heavily sandbagged, I believe, in my opinion. What are some of the cautions, right? First and foremost, use in-the-money leaps with an 80 delta or higher and 1 year till expiration. Why? You want them deeper in the money in case you're wrong and it starts to go backwards. You have a way to be able to get your money back out of this thing. You don't want that long call to be out of the money. You want it to stay in the money. You also want that 80 delta because you're getting the equivalent of 80 shares worth of movement. By the way, if you had 2 of those, 2 times 80 is 160. That's like the equivalent of 160 shares worth of price action, okay? So that's one. And over a year, so that you can carry this scheme, as we call it, or this plan, this strategy, pun intended, this strategy out, because I showed you the numbers for 1 year. What if you continued to do this for the full 2.3 years for the length of that long call? You could be looking at, guys, because 2027, that's still a little over 2.3 years away. You could be looking at generating somewhere in the neighborhood of tens of thousands of dollars off of this, 10 up to $40,000 or $50,000 worth of yield, in addition to the fact that those two underlying leaps might be worth $20,000, $30,000, $40,000 a piece, right? So it's a great strategy to do, especially over a long haul. Sell the short. It also gives you practice on selling calls, selling short calls, timing them appropriately, when to roll them, when to hold them, when to fold them, etc. Number two, you want to sell short calls with 20 plus deltas for more juice. Don't sell covered calls that are so far out of the money. You're not in this thing to cost you money. You're in it to make money. If you got called out, you get called out. You made money. You go on and you can apply it to a different asset, maybe the same strategy, but a different asset, right? If for some reason MicroStrategy goes on an absolute heater and you got called out. But I'll even go to deltas of 30 to 50. What does that delta mean on the short call side of things? It means selling them closer to the money versus super far out of the money. An example would be, remember we sold a 410 call in this example. That'd be like going and selling the 500s. You're going to get like pennies for them, like 25 cents or $25 each time you sold one. If that's what you're in it for, is to make $25 a clip every 3, 4, 5, 6 weeks, then have at it. But I'd rather make hundreds, if not 1,000 or thousands of dollars every 3 to 6 weeks versus 25 to 50 bucks every 3 to 6 weeks. Okay. So that's why we said use tighter delta or higher deltas so that you're tighter to the money instead of further out of the money. Number three, you want to maintain the spread between the long and short calls. We kind of went over that ad nauseum. The spread, what do I mean by that? If you have a long call at 250 and you're selling a 400 against it, there's a 150 spread between the two of them. If you did nothing and it closes above 400 and you get called out of your long call, they're going to replace your long call with $15,000 in that case. Regardless of if the call shows a price of $20,000 or $30,000 on option strat or on any of those other tools that we use, it doesn't matter. The most you're going to get is, again, in that case, $15,000, right? Number four, you're on the clock, right? Remember that. That's a caution. This isn't like shares where shares never expire. Think of this as you can't just sit there and get up, 20 points ahead in the basketball game and pass the ball around for the last 15 minutes of the game. You got a 20, 30-second shot clock up there, and you got to put off the best shot you can in the time that's allotted. Same thing with options. Options expire. You're constantly on the clock, so you want to be doing these things judiciously so that you're constantly generating more and more yield versus falling behind on the clock, okay? What are some of the other precautions, big-time precautions? Call options can expire worthless. So going back to that same example, if MicroStrategy dumps and goes down to $200 a share, well, guess what? Your 250 long call is worthless at that point. It would expire and be worth nothing. So you better be aggressive about your covered calls at that rate, because you don't want this thing to cost you money in the long run. You want this thing to be generating money, to be a money generator. Also, another reason why we buy deeper in the money call options instead of buying them up there in the 300 or at the money 330, we're buying them deeper down in the 200 to 250 range. The deeper you go, the safer they are. It's going to cost you a little bit more at the beginning, but you'll be able to put the short call a little bit lower down. Right? If you think about it, short call a little bit lower down and be able to maintain a similar spread. For example, 250 to 400, that's a 150 spread. 200 to 350, that's a 150 spread. You're going to get $15,000 in either of those cases if you got called out. Another precaution, volatility dumping, right? Implied volatility contracting or the volatility just falling off like it kind of has with MicroStrategy lately. That'll cause those short call prices to dump. You won't be able to get as much for each of those covered call or short call rolls. So that'll lower the juice or lower the amount of return that you're going to be able to get from this thing, right? So that is another precaution. And then also black swans, they're not your friend. Again, going back to the example before, if a black swan hit, something happened to the Bitcoin network or something happened to MicroStrategy and they were unable to fulfill their obligations, and all of a sudden, bam, it fell off a cliff and dropped to 200 and closed at 200, you could lose everything that you paid for that call option. You can't lose more than that, but you can lose everything that you paid for the initial call option, less whatever you collected along the way in short calls. Why MicroStrategy? And by the way, another great one is Tesla to do this with, is another great one to do this one with is Tesla. Oh, but what if I get called out? You should already have some Tesla shares. You should already have some synthetic longs or leaps or whatever else for the long haul for Tesla. But between here and the end of 2027, wouldn't you rather have another strategy that generates a little cash along the way for you? This one's it, okay? So that's all I'm going to say about that one. But why MicroStrategy? High implied volatility. It typically has a very high implied volatility. It's been compressed over the last 3 months or so, right? But a higher volatility equals higher premiums, juicier premiums, right? Why MicroStrategy? They're in the money leaps, have very tight spreads and high liquidity. So they're easy to buy. You can do more than one of these. Some stocks have a very limited amount of float in their options market, has very low liquidity, not very many contracts, basically is the way to say that. And in that particular case, you're fighting over others and the bid-ask spread gets really wide and you may be overpaying for those options. In the case of MicroStrategy, they run expensive anyway because of its high implied volatility, but conversely, the short calls also give you more money as a result of that. So it kind of cuts both ways. Another reason why MicroStrategy, Saylor tweets more and more Bitcoin every Monday, so that they buy more Bitcoin every Monday. He's constantly talking about the preferred shares. The preferred shares are increasing their percentage, returns. He's going after all these other deep pools of capital, and all that is constantly increasing the sats per share that at some point when Bitcoin makes its parabolic move, MicroStrategy has to follow at that rate. It just has to. And the reason why is increasing sats per share is increasing the amount of Bitcoin. So you don't need as many shares to equal a whole Bitcoin. And if Bitcoin then all of a sudden goes from 110, where it is now, 113, and goes up to 140 or 150, if MicroStrategy doesn't move, all of a sudden the MNAV is going to drop all the way down to 1 or maybe even below 1, right? And at that rate, it would have to go up. If nothing else, Saylor is going to turn around and buy more shares of the underlying. He'll buy the MicroStrategy shares back when the MNAV goes under 1. That's already part of the master plan, okay? So bottom line is you got this PR machine that's constantly going, right? Constantly all over X, all over the media, all over the news. There's the talk of the S&P 500 inclusion. There's so much goodness coming down the road that all that excitement causes the implied volatility to go up, which causes the premiums to go up, which means you can turn around and sell covered calls and generate more income on a monthly basis. Also, that Bitcoin convexity. So you have that asymmetrical upside, right? Limited downside risk, asymmetrical upside risk, especially over the course of the next 2.3 years. So basically, MicroStrategy pops, the implied volatility increases, the short premium calls rip upwards, and you collect more and more and more premiums. Guys, I hope you found value in this today. If you did, make sure you smash that like button. Make sure you're subscribed to the channel so you see more videos of mine and like mine. Chances are it'll probably suggest Adam's channel to you because he and I are kind of on the same wavelength with some of these things. Also, drop a comment below. Let me know, what did you learn today? What did you like best about what I went over today? And what would you like to see more of in the future? Don't forget, I teach courses on TradingView and technical analysis along with understanding options. Right now, I think there's a few coupons left with the coupon code LABOR, LABOR 20. LABOR 20 to save 20% off the courses. My individual coaching is not on sale. That remains the same, and there's a very limited number of one-on-one spots. All that's over at gdenarocoaching.com. And finally, thanks for tuning in, guys. I'm G Denaro. I'm here to help you increase your financial literacy, to help put you and your family on that path to financial freedom. Thanks for tuning in, and we'll see you next time.